What's going on, guys? Welcome back to the channel. For those who are new here, my name is Leo, and in this video here, folks, we're going to be doing a stock analysis on Starbucks. We're going to look at the fundamentals, the financials, and finally determine a price to pay for this business. Jumping in to the stock research tool here, we have Starbucks pulled up, trading at $74 a share. A lovely price decrease, and we're ranking this a 6 out of 10. Now, Starbucks has made headlines due to their push for a union, as well as the earnings report just came out. So let's look at this price decline and see what this company is all about. So 6 out of 10, we have a 5-year PE average ratio at 43.40. Now, folks, if you know me, and we know the channel, we like to see this number underneath 22.5. We have that here in our PE trailing 12 months number. Now that could be due to this, well, massive price sell-off starting at pretty much the tail end of 2021 and going into 2022. We've just seen that price started to come down, and we can look at that, 126 on the high side in the 52-week range. So low PE or high PE ratio, as it is decreasing, so that is somewhat of a positive. Our current ratio, folks, this is a little bit more of a red flag, sitting at 0.81. Now, folks, we want to see this number to be 1.5 or higher. That would indicate to us that Starbucks has enough assets on hand to cover their liabilities. Sitting at 0.81 is not a good number, because in case bad things happen, shit hits the fan, in a better terminology, they won't be able to cover off their debt, and we want them to be in a safe predicament. Now, where they are starting to earn some points is the return on equity segment. Look at this, folks, 58.14 on average. However, keep in mind, trailing 12 months is sitting at negative 62.24. So just something to keep on the back of your head, folks. This has probably been a little bit of a rough year for this business, but over the 5 years, it's been pretty solid. EPS growth is up, 256% increase from our 5 years over to our trailing 12 months, so that's good. Now, another ratio, this company just knows how to rack in debt, and it seems to me like that seems to be the major problem of this business so far. From our current ratio and now jumping into our debt to equity, we are sitting at negative 400%. Now, if you know me, folks, I like to see this number underneath 50%. I like to see this number underneath 50% or 0 to 50%, because that would indicate to me that they have enough equity on hand and they're building their business through equity and not taking on debt. When we have a negative number, folks, this is a red flag, because this could mean to us that this company could be on the financial stress, potentially on the verge of bankruptcy, and that there is not enough shareholder equity within the business. So this, to me, is a huge red flag. And listen, folks, I'll tell you straight up, I have shares in this business. So as a shareholder, I am not too happy to be seeing these numbers. So red flag right there for Starbucks in the debt to equity range, as well as our current ratio. Not looking too hot. Moving over to share dilution, similar story, 0.57% increase in the shares outstanding. We want to see this number staying the same, and that would indicate to us that they're not diluting us, but unfortunately they are. So I'm not too thrilled. I'm not too thrilled currently as a Starbucks shareholder. I mean, I have sold off a portion of my position when the price was much higher to buy shares of Intel. So I'm kind of glad I made that decision. But nonetheless, I like this business. I like their moat. I like what their brand is, because listen, here in Canada, the top brand was Tim Hortons coffee. And Starbucks came around and pretty much threw the whole industry for a loop. Starbucks has a strong brand, overpriced coffees, but the coffees are good. But you know, there's that feeling of premium when you're buying one of their products. That's just my opinion. I mean, I'm not a huge Tim Hortons guy, but fellow Canadians, let me know if you agree. Write down in the comments down below. Now, where they are earning some good points here, last 4 categories: strong net income growth, strong free cash flow growth, a really strong return on invested capital average, 24%. We want to see this number to be 10% or higher. And a 5-year revenue growth at only 7% increase. An increase nonetheless, but pretty low. But I mean, you know what? For considering how many Starbucks actually exist, like I'm seeing them pop up more and more. You would think the revenue would be up higher, but I'm guessing well, this is just coming from one demographic here in Canada. I guess their overseas operations are getting hit harder than usual. An $85 billion company, yeah, I mean, there's a lot to work with. Scanning over here in our Almond Z-score of 2.70. I'm not too thrilled about that. We want to see this number over 3. That would indicate to us that they are safe from bankruptcy. So it kind of just ties into the story of what we have here with our current ratio and our debt, as well as our Piotrowski score is very mediocre. We want to see this number to be between 7 and 9. So folks, upon looking at Starbucks, oh, here's something else to keep in mind before I finish that statement. We do pay out a dividend. 2.53% dividend, and we're paying that out at $2.1 billion. Now, here is a huge red flag that I'm seeing here. Not that the dividend is not safe, because it is. At $4.1 billion average free cash flow, and our current free cash flow is 4.46. My concern is our dividends are taking up half of our free cash flow. That's a lot of money. Half of our free cash flow when we could be using that to pay down our debt. If I was on the board of directors, and probably there's good reason that I'm not, but I would say ditch this dividend, funnel it into your free cash flow, and get your debt under control. That seems to be a major player in this whole issue right now. I would love to see that. And if the shares are cheap enough, buy back the shares. Get this share dilution under control. Not that it's crazy, but that's something I would like to see. Anyways, I'm not too thrilled about Starbucks, and this is coming from a Starbucks shareholder. I think the price currently, if it is low enough, I might pick up some more shares, but I'm kind of worried about how management is going to handle this debt issue going forward. I'm kind of glad I trimmed my position, but I want to see because if the price is right, maybe we'll pick up some more if I can stomach all this. That's a question I got to ask myself personally. Let's go into a price analysis, folks. But before we do that, if you're enjoying the video so far and you're enjoying the software, hit the like button and the subscribe button. It means a lot to me. It means a lot to the channel. And this app that you see in front of me is going to be an app for you, the subscribers. So stay tuned. I'm working with developers. We're getting it up and running. It's going to be great. There's going to be added features. It's going to be a whole thing. And look, guys, let me just show you this stuff just for a quick second because I like to brag. We got income statements, cash flow statements, balance sheets. We got everything. You want to look into all the details of the business. You got quarterly, annual reports, whatever you want. It's coming. It's going to be great. And yeah, I can't wait to share that with you. I only just use this because this is all filters everything through. This is the main page. But there's so much to come and so much to see, and you're going to honestly love it. Anyways, enough of my big head. Let's jump into a price analysis and figure out what we should pay for this business. Now, I'm going to fill out these boxes. We'll do a 10-year analysis because 10 is a nice round number, and I think Starbucks should be around for 10 years. So let me fill these out, and I'll get back to you in just a quick second. So we filled out all these boxes here, and if you know me, and if you're new to the channel, I like to try to be conservative as possible in the sense where I want them to crush my numbers. I want them to do extremely well, but I also want to put numbers in that I know that it can potentially hit. So being reasonable with a revenue growth of 5, 6.5, and 7% just makes sense to me, considering they've done 6.9, 9.46, and the 1 year of doing 23.57. Some may seem that it's a little bit too conservative, but I gotta assume the absolute worst for this business just due to how they've currently been performing, because I have no idea what the future holds. Profit margin, similar numbers. I'm just giving myself a slight discount on the conservative side. Same thing with free cash flow margin. This is a slight discount. I like to stick to like the lowest numbers that they've kind of done, because as I was saying, if they beat these numbers, it's better for us. Price to free cash flow, I'm going to go with 14, 16, and 18. I'm loving that this price to free cash flow number is 19. So it kind of plays in pretty well currently what we currently have. Same with the PE ratio, 14, 16, and 18. Now let's do our desired return. I'm going to put 13 in the boxes here. And what do we got? So $74 is our current price. Average calculation comes out to be $68.29. Now on the high side, okay, this is actually pretty funny, because this is what I paid previously for this business, around $80, 85, 80 something dollars a share. And then it went up to about where 100. What did I sell off? I think I sold off a little bit, 110, a couple of shares to get some Starbucks, some Intel shares. So I trimmed that. Now we're down at 74. So what do I think about this business? I definitely think I will wait until it gets into this realm, granted with all the information that's coming out, and seeing what happens if things eventually move towards a union. This aggressive category is a unicorn. Now, they very well could be hitting revenue growths within this 23 and 9 number. You know, that very well could happen. I just gonna put this as a write-off, just because as things started to open up again with the pandemic, I mean, things have been open up over the last little while. In Canada, not so much, but I mean, in other places of the world, people started going out more, visiting coffee shops, so they should be getting back on their feet. It's just how long till our numbers start going back up? That's the main question. So that's why I stuck with the low revenue growths. Now, it very well could be that 7% revenue growth, as I got right here, might be a conservative amount. I'm kind of curious. If I just plop in 7 into this number and keep everything else the same, what? Pulls out to 57. Not a huge, well, $10 more. So ideally, what I want this company to do is kind of get into the $70 range. If I get below $70, then yeah, I might just be picking up some more and just try to justify my average down. Honestly, for the few shares that I do have left, it makes sense that I could probably average down to this price here. But ideally, I want to put something with a little bit more margin of safety just to make it worth my while. Because when I did buy these shares, those were a few years ago, and that was before the pandemic. Definitely, yeah, it was 2018. So I felt more strongly about these numbers at that point. Now, not so much. And with the debt to equity that we're currently sitting at, a current ratio, and the slight dilution, and with the dividends being paid out, I don't know. This is a company you have to do further due diligence on. And it's a tricky one for me to answer because I'm currently involved with it and involved in this business. I like their products. I like the brand. I like their moat that they have in terms of the coffee shop premium feeling. Like when you think Starbucks, for me, I think immediately like an Apple product. They kind of have like that similar approach. Like the two kind of go hand in hand. And you probably know that whole scenario. You have the author. They have a MacBook. They're sitting at a Starbucks. Like there's a whole setup. The Apple products and Starbucks kind of go hand in hand. Word of advice, all the single guys out there. If you bring a girl on a date to a Starbucks, the more complex her drink is, the more headache she's going to give you. That's just my little tidbit of information. Don't listen to me though. It's just my experience. But where does that leave you, viewers of this video, watching? If I was a new investor invested into Starbucks, or trying to invest into Starbucks? What would I do? I would wait until the prices come down till sub 70 and then jump in. For me, as someone that has a stake in the game, I might just do the same thing before I begin to average down. Now, granted, I don't know if the price might get that low. It might be worth my time to just buy in at 74. However, I gotta revisit my I gotta revisit this evaluation, because it's been a hot minute since I actually looked at my Starbucks shares, because it's such a minuscule position in my portfolio. But yeah, as someone that's brand new trying to get into this company, it's a strong brand, but I don't agree with where things are going financially. And that's my take on it. What is your take? If you want to see a company being evaluated in my software here, write it down below in the comment section. I listen and I watch and I look at all the comments. Bro, like they're text. But I read all the comments. That's what I want to say. I read all the comments, and I really appreciate when you guys write stuff down. I truly do. So write down a company you want to see evaluated and write what you think about Starbucks. Yeah, let me know. That's the video. Thank you guys so much for watching. I'll catch you in the next one. Until next time.